keep reading over and over again are this 25x multiple applied to John Deere's earnings. That is not a trough. It just isn't. In fact, it's higher than basically every other year in real terms except for the last ag boom. So, one thing you can do is just sort of reframe it, right? Is it a trough? Well, it's down 38% from peak. But realistically, it's also up 65% from what any reasonable person would identify as a trough, which is the late 90s, strong dollar, old fleet, a whole bunch of things really drove that trough. But that's where you saw a bottoming in real investment. And you're still up quite a ways from there. You're at a fairly middling number right now. You could maybe argue it's mid-cycle, but you got a ways to go. If we look at on slide 15, we can do the same thing for Deere. We have their sales, we have their annual reports, actually way back further than that, and they're very entertaining to read. If you're interested in old Deere annual reports, we have them since the teens. Great pictures, great accounting changes over time. And what you can see is these are also not a trough. And that the problem you have with cyclicals is that they really, really, really look expensive at the trough, and they really, really, really look cheap just past peak. That's why there's such easy value traps to fall in. And no matter what ratio you apply or metrics you apply, it just is very hard to step back and get the context of this kind of a long-term sales chart. So what are the takeaways? We're a little over time. Upshot, we expect a disappointing fiscal 17 guide. You have this combination of lower sales, I think pretty clear. We can see that from orders and industry activity. We have higher costs for inputs like steel, incentive comp. We can see that coming. And we should have significantly lower financial segment profitability. I think we can see that coming because residual values are down and provisions are going to have to go up. So I think we're looking at a disappointing guide. Misapplication of trough multiples is a big valuation framework problem. It's why the shares we think are in the wrong zip code, right? They shouldn't be trading at anything like $91. You should have about 1.4 times book for the finance subsidiary and about 15 to 20 times whatever for the equipment earnings. Neither of those are a trough. But the most important thing, since I'm sure other people recognize some of these dramatic mispricing, is you have the ability to short squeezes here, right? So you don't want to just press lows. People, the way I frame this is people kind of expect some bad news in Deere. That's why it's so heavily shorted. It's not like Valiant. It's not going to come unwound. So you don't press weakness.